Chapter 23 is about rules governing the issuance and trading of securities. The first thing that they talk about is the summary of federal securities legislation and the Securities Act of 1933. That regulates the initial offering of securities by public corporations by prohibiting an offer on a sale of securities not registered with the Securities and Exchange Commission. Security Exchange Act of 1934, also known as the Exchange Act, regulates the trading in securities once they are issued. The Public Utility Holding Company Act of 1935 requires public utility and holding companies to register with the SEC and to disclose their financial organization structure and operating process. The Trust Indenture Act of 1939 regulates the public issuance of bonds and other debt securities in excess of $5 million. This act imposes standards for trustees to follow to ensure that bondholders are protected. The ICA Investment Company of 1940 authorizes the SEC to regulate persons and firms that give investment advice to clients. It requires registration of all such individuals or firms and contains anti-fraud provisions that seek to protect broker-dealers and clients. The Securities Investor Protection Act, the SIPA of 1970, established the Nonprofit Securities Investor Protection Corporation, which is the SIPC, and gave it authority to supervise the liquidation of brokerage firms that are in financial trouble, as well as to protect investors from losses up to $500,000 due to the financial failure of a brokerage firm. The FCPA of 1977 is the Foreign Corrupt Practices Act. As amended in 1988, prohibits the direct or indirect giving of anything of value to a foreign official for the purpose of influencing that official's actions. The ISECA, International Securities Enforcement Corporation Act of 1990, clarifies the SEC's authority to provide securities regulators of other governments with documents, information, and exempts from Freedom of Information Act disclosure requirements. All documents given to the SEC by foreign regulators. The Market Reform Act of 1990 authorizes the SEC to regulate trading practices during periods of extreme volatility. And it also mentioned the securities enforcement remedies, the Securities and Exchange Commission, which is otherwise known as the SEC, the SEC, the federal administrative agency charged with overall responsibility for the regulation of the securities, including ensuring that investors receive full and fair disclosure of all material facts with regard to any public offering of securities. It has wide enforcement powers to protect investors against price manipulation, insider trading, and other dishonest dealings. Also talked about security, a stock or a bond or any other instrument of interest that presents an investment in a common enterprise with reasonable expectations of profits that are derived solely from the efforts of those other than the investor. Talked about the underwriter, which is investment banking firm that agrees to purchase a securities issue from the issuer, usually on a fixed date at a fixed price, with a view to eventually selling the securities to brokers who in turn sell them to the public. mention red herring, letter of comment or deficiency, shelf registration, which was a procedure whereby a large corporation can file a registration statement for securities it wishes to sell over a period of time rather than immediately. Due diligence defense, an affirmative defense raised in lawsuits charging misrepresentation in a registration statement. It is based on the defendant's claim to have had reasonable grounds to believe that all statements in the registration statement, it is based on the defendant's claim in the registration statement were true and no omission of the material fact had been made. A broker is defined as a person engaged in the business of buying and selling securities for other accounts. The exchange market is a securities market that provides physical facility for the buying and selling of stocks and prescribes the number and qualifications of its brokers and members. These brokers buy and sell the stocks through the exchange's registered specialists who are dealers on the floor of the exchange. Over the over-the-counter market, a securities market that has no physical facility and no membership qualifications and whose broker dealers are market makers who buy and sell stocks directly from the public. The tender office, which is a public offer by an individual or a corporation made directly to the shareholders of another corporation in an effort to acquire the targeted corporation at a specific price. Insider trading, which is the use of material, non-public information received from a corporate source by someone who has a fiduciary obligation to shareholders and potential investors and who benefits from trading on such information. And then chapter 24 is about antitrust laws. Trust, which is a business arrangement in which owners of stocks in several companies place their securities with trustees who jointly manage the companies and pay out a specific share of their earnings to the security holders. The Chicago School, which is an approach to antitrust policy that is based solely on the goal of economic efficiency or the maximization of consumer welfare. The Harvard School, an approach to antitrust policy that is based on the desirability of preserving competition to prevent the accumulation of economic and political power, the dislocation of labor and market inefficiency. A class action suit is defined as a lawsuit brought by a member of a group or persons on behalf of all members of said group. The Sherman Act is federal statutes that make illegal every combination, contract, or conspiracy that is an unreasonable restraint of trade when this concerted action involves interstate commerce. Collusion, concerted action by two or more individuals or business entities in violation of the Sherman Act. Conscious parallelism is identical actions, usually price increases, that are taken independently but nearly simultaneously by two or more leading companies in an industry. Restraint of trade, action that interferes with the economic law of supply and demand. Horizontal restraint of trade that occurs between competitors at the same level of the marketing structure. Horizontal price fixing, collusion between two or more competitors to set prices for a product or service directly or indirectly. Horizontal division of markets is collusion between two or more competitors to divide markets, customers, or product lines among themselves. A horizontal boycott is a concerted refusal by a trade association to deal with members that do not follow the association's regulations. Vertical restraint of trade is restraint that occurs at different levels of the marketing structure. Vertical price fixing is stipulation by a manufacturer to a retailer to which it sells products as to what price the retailer must charge for those products. A monopoly is an economic market situation in which a single business has the power to fix the price of goods or services. Predatory pricing is pricing below the average variable cost to drive out competition. The Clayton Act prohibits price discrimination, tying exclusive dealing arrangements and corporate mergers that substantially lessen competition or tend to create a monopoly interstate commerce. Primary line injury, a form of price discrimination in which a seller attempts to put a local competitive firm out of business by lowering its prices only in the region where the local firm sells its products. Secondary line injury is a form of price discrimination in which a seller offers a discriminatory price to one buyer but not to another. Tertiary line injury, a form of price discrimination in which a discriminatory price is passed along from a secondary line party to a favored party at the next level of distribution. A merger is one company's acquisition of another company's assets or stock in such a way that the second company is absorbed by the first. Horizontal merger, a merger between two or more companies producing the same or a similar product and competing for sales in the same geographic market. Vertical merger, a merger that integrates two firms that have a supplier-customer relationship. Conglomerate merger is a merger in which the businesses of the acquiring and the acquired firm are totally unrelated. Pre-merger notification requirement, the legislatively mandated requirement that certain types of firms notify the FTC and the Justice Department 30 days before finalizing a merger so that these agencies can investigate and challenge any mergers they find anti-competitive through the Federal Trade Commission. These chapters were overwhelming for me. That's a lot of information about federal trade and different laws, and all of that information I'm really unfamiliar with. I understand what a broker is. I know there's a stock market. I've seen it on movies where people are trying to buy certain stock whenever it's at a certain number. I know that if stocks are high, the president's looking good. If the president isn't looking good, the stocks are down, is what a lot of people say. It all balances out, and going back to the economy, and I know right now with the pandemic going on, everyone is concerned about the economy and when can we, quote, reopen Ohio and everybody get back to their jobs. When will it be safe? And yet think about what that's going to look like. I know in Ohio they've been saying that we will be wearing masks for a year, is the latest that was said the other day. It hasn't been mandated yet. I watched the governor today, and Amy Acton said it hasn't been mandated yet, but she made mention that New York and Massachusetts made it a mandate today. So yeah, everybody is in a hurry to open back up and get things moving again financially, but ultimately we have to stay safe. And until they have a vaccine, they're not really sure what that looks like. So there's my take on the chapters.